Harding Loevner is a global equity manager, and we focus on investing in companies regardless of country, sector, or industry, focused on investing in just quality, growing businesses. Companies that can generate sustainable profitability over cycles, but can compound that profitability with growth over the long run. And we seek these companies all across the world. A lot of managers look for quality growth businesses and follow a disciplined process as we do, but what makes us unique and different is the way we go about it, what we call collaboration without consensus. All of our work, all of the analysts, the PM decisions are done in a completely transparent way to invite debate and challenge, to make sure we're focused and getting the best insights as opposed to just looking at companies that we fall in love with. So invite that debate, benefit from group wisdom, but in the end, preserve individual accountability, whether it's analysts rating companies or portfolio managers constructing portfolios. We want to drive out consensus and compromise. So that unique approach to doing our research and making decisions in the portfolio is really what stands our process apart from our competitors. Historically, our portfolio has generated excess performance in a very consistent manner, tending to participate in rapidly rising markets, outperform in more normalized, fundamentally driven markets, and outperforming when things are difficult, as they are now. Unlike past downturns, going back to the IT bubble around the turn of the century, or more recently the Great Financial Crisis where we saw sharp sell-offs, our focus on quality and mindfulness of the price we pay for stocks has helped us defend. In this downturn, it's been a bit unique. Obviously, value stocks have done better, growth has underperformed, which is a headwind, but uniquely, quality stocks have also underperformed. That style headwind has undermined our defense and performance this year. In the current inflationary environment, growth stocks have underperformed. We don't know when this will change or when it'll turn. Styles tend to be cyclical, but we have no idea when the change will occur. What I do think is a little bit different is separating quality and growth. Right now, quality growth companies have fallen, but over time, growth companies without strong balance sheets, without a history of earnings, if we have a continued sort of inflationary environment, I think that'll continue to pressure those companies. Whereas quality businesses, ones that have some sort of competitive advantage to drive margins over time through things like pricing power, I think will separate. Those companies can deal with an inflationary environment better, such as rising their pricing to preserve their margins. And I think we'll start to see a separation between growth stocks and quality growth companies, and I think we'll see those start to outperform sooner. I think in general, equities and economies aren't exactly the same thing. And much of a potential recession, I think, is already discounted into the stocks around the world. Of course, if the recession turns out to be much more severe than people are currently forecasting, I think all equities will suffer. I think our focus on quality, our mindfulness of the price we pay for stocks should help separate performance in that environment, but I would expect challenging times. Looking beyond that, though, I think those difficult environments can be an actual period of time where those stronger businesses can improve their competitive advantage. A lot of weaker players fall by the wayside. So maybe in the midst of the recession, performance won't be great, but looking beyond that, I think that sets up our companies and in turn the stocks of those companies to perform well in the medium and long term. In the midst of the sell-off, a number of great businesses, their stocks have suffered far more than the underlying fundamentals to the business. So when I look at our portfolio, there's a number of areas. Technology stocks, hard hit area, not surprising. A company like Synopsys, it's all involved in the chip industry, but instead of doing chip manufacturing, it does software design of chips. It's a business that's much more stable, so even as the chip cycle rolls over, companies are investing for the next design, the next generation. So they're using Synopsys' software. We've actually seen earnings and come up even as the market environment's gotten weaker. In an area completely different, in industrials, a European based company, Schneider Electric, I think is another good example. It seems like it's sort of at the nexus of the worst place to be. Europe and industrials. If you see a recession coming there, which is likely, you'd think that would be a bad company. The stock reflects that, down 40%. But if you look through to the business, they're involved in energy management and factory automation. So even as things have gotten more difficult, in the world where we're seeing rising energy prices, we're seeing geopolitical tensions leading to, some reversal of globalization. You see companies reshoring or onshoring their factories. Schneider's benefiting in both parts of its business. So we've seen rising orders for its energy management equipment and solutions, and we're also seeing rising orders for its factory automation. So again, looking through the current difficult environment, looking through what a company is actually located or what industry it's in to the business itself, and we find these opportunities where there's that market dislocation in the stock price, but the business remains strong. And so those are the types of companies we're sticking with or adding to the portfolio. Patience, I think. In the midst of a difficult market environment, sometimes it's difficult to stick with the companies you own, to maintain your discipline, maintain your philosophy, but we see it as a real opportunity. When there's periods of dislocation in the marketplace, a lot of great businesses that always look too expensive to us, or companies we own where valuations were stretched, we're seeing a great trade-off. And so it's difficult, but in times of dislocation, sticking with your discipline to own great businesses, now at better prices, maintaining that throughout will lead to better performance in the medium and long term.